Well, let's now take a look at what you should actually be doing by talking to the real experts. Some of the people who really understand. We're going to talk to people across from real estate to the equity market. And let's start by taking a look at the equity markets and at mutual funds. So we have Radhika Gupta joining us, the CEO of Edelweiss Asset Management Limited. Feroz Aziz, the Deputy CEO of Anand Rathi Wealth. And Dhirendra Kumar, the CEO of Value Research. All three of them with us right now. Thank you so much for joining us. Every Diwali, Dhanteras, I try and put out this show saying, what should people be doing with their money? Where should they be investing their money? So Feroz and Radhika, I'm going to be asking you about the equity market in some detail. But Dhirendra, why don't I start off with you, because you advise people on mutual funds across the board. So if you had to tell somebody right now, asset allocation, because that's a key thing, divide your money into equity and debt and cash and other things, what would you tell people to do right now? Where should they be putting their money?
Yeah, there are only two broad asset allocations which anybody should follow: equity tilted or debt tilted. And whether it be 80%, 75%, 60% is your choice. But any long-term investor should not be scared out of the market today. Market may not fall even if it might look expensive for a while. So don't try and be tactical about it. There are few rules to follow, which is, be diversified at all times. Don't look for, this sector, this segment, or the small cap, mid cap. Be in an all cap portfolio, howsoever it be, Whether you pick 3 funds or whether you pick 5 funds or whether you pick a multi-cap fund and a flexi-cap fund. Make sure that you're diversified at all times. Yeah. Second is that don't try and time it, and that Indian investors have embraced beautifully in terms of the steady rise of SIP, and the SIP book is quite awe-inspiring. And that has created a context which is we have such a large number of happy mutual fund investors today. Right. Third is that most people would like to be most people will be disappointed if they try and be tactical. Be guided by your goals. If you don't need your money for next 5 years, don't worry about what the market is going, where the market is going tomorrow or day after, because you won't be able to perfectly time it anyway.
All right. I think that's really important lessons, and I know, Dhirendra, you've often talked in shows like this about the importance of systematic investment planning, or SIP. I think a few years ago I said that SIP is the most important word that investors, retail investors who are really watching this show should be keeping in mind, which means put a little bit of your money into the market every month. Don't try and time it, because you will not be able to time it. Even the best experts don't time it. Let me throw the second thing which you were referring to Radhika, and then I'm going to toss the same thing to Feroz, which is asset allocation. So Radhika, about that, and Radhika, you've been very closely involved with AMFI, which is mutual funds. For a retail investor, the basket that they have becomes a really important thing, right? Whether you should have 100% of your money in equity, 75% of your money in equity, 25% in equity, and within equity, what should you be investing in? That is also very clearly driven by who the particular investor is. If you've got a lot of money and you're young, maybe you can take more risks. If you're older and you need that money, take fewer risks. Asset allocation, is that one of the most important mantras?
It is. It's a very critical mantra, and it's one of those mantras people often forget in a bull market, because people start thinking, I can afford to put everything in equity. I don't need to worry about when the market corrects and protection. And I think the reason for asset allocation is this, different asset classes perform well at different times. Even if you have a truly long-term holding horizon, there are times when you need to take out money for whatever reasons, and equity markets are up and down. I mean, they were down 50% in 2008. And having protection is important. It keeps you in the equity markets longer. Now, how do you go about doing your asset allocation? I think the answer is very personal there. I mean, I would just say a couple of things. One is, even if you're the highest risk investor, please have a contingency fund that takes care of your expenses for 6 to 9 months, because as I said, you never know what equities do. The second is, I think the answer is really personal. And I don't think, Vikram, it is dependent on age. My father is probably 70. He's a very high risk investor because he has a fully paid up home. His kids are independent. He earns pension. So he's a full equity investor. I'm much younger than him, but I have a much more conservative portfolio because I work in a high risk industry called capital markets. So I think asset allocation is extremely personal.
Okay, I'm going to come to the specifics of it, but let's not try and break that up into numbers, and I'm going to come to all of you on that. Feroz, you've heard the theory, and the theory which is being outlined right now is crystal clear theory, and virtually every expert will tell you that. Keep your money for the long term, don't take risks more than what you can afford, diversify your portfolio, put some into this, some into this, some into that, do it for a long period of time. Don't think you can time the market, because then that becomes gambling more than investment. That's how you really make a lot of money. Anything you'd add to that theory, and then the specifics of it? If you're a retail investor, what sort of an asset allocation should you be doing right now?
Hi Vikram, I think very importantly, asset allocation, like Radhika and Dhirendra have also said, is very important. But it's also very important for us to see as stakeholders of this industry, or what is the current asset allocation of Indian households. Indian households have about 670 lakh crores this year, give or take 5-10% tolerance, and you'll be surprised, or I was at least surprised, to see that there was more money in currency, savings accounts and bank account than we have in equity mutual fund. To my mind, the ideal asset allocation is 75%, at least if you have monies greater than 5 years, and several of us do. Secondly, like Dhirendra Saab said, valuations can remain elevated and for really long periods of time. I was very surprised to know that when Nifty was at 10,500, we had the same PEs as we have today, because Nifty is at 19,400, give or take. But the earnings have moved up from 532 to 946, which is what we expect to close this year, and the first 2 quarters have gone beautifully. So don't expect price correction is the only way to get valuations cheaper. Earnings growth also brings down valuation, and in turn gives you price movement. So point is, we have a large role to play over the next 10 years, and because the last 10 years, if I looked at 2012 data, 270 lakh crores was the household savings, and that point in time we had 51% in financial assets. Now it's just 52%. So for all what has been spoken on financialization, we have 1% more.
Right, interesting point you're making, that over a period of time, equity is going to give you very good return. Let me just throw that to the other two. Radhika, let me go in reverse direction this time. Radhika, given the fact that the Indian economy is growing the way it is, and it's likely to continue to grow, so if you're saying, what's it, 6-7% economic growth, then you add inflation to that, then you add corporate earnings will be higher, you could possibly be making 12, 13, 14% in the Indian equity market over a long period of time, is what you may expect. Now, there'll be ups and downs, obviously, which is why you've got to be careful. Don't be a short-term investor. But for a long term, if you're investing, would you also be comfortable for a lot of people to have 70-75% of their money in equity markets? Or do you think that that's too high? And what's your overall take on where you think equity markets are going to go in the next few years?
So look, I mean, I'm as much of an optimist as others on the panel. I think if you look at the last 20 years of equity markets, we've probably delivered about 12% headline equity growth. And Vikram, I would say this wasn't the greatest period for India. We had multiple different parties in power. We had Asian financial crisis, we had global financial crisis, we had COVID. There was so much going on. And I think sitting today, where the Indian economy is, and one of the things that I get most excited about is really the meeting of top-down policy with bottom-up what companies want, which I think, is relatively unique to this era. I think the past is already a golden example, and the future could be even brighter. So one, I'm very optimistic. I also think that the last decade for India was a little bit of a lost decade as far as earnings growth. That is turning around. So earnings have finally come, and you're seeing the numbers in corporate earnings, you're seeing the numbers in private investment. So I think there are a lot of things to be bullish about.
All right, Dhirendra, your advice at the end of the day, right now, fine, I've got X money, or I'm trying to figure out what to do with my money. Where do I invest it this Diwali?
I think that, as Radhika was saying, it's very personal. So it depends when you need to really draw from that investment that you are accumulating. If you are still in your early phases of accumulation, have a larger allocation to equity and keep it multi-cap. That is, hybrid is a great way of doing it for any new investor, because we keep talking about asset allocation, we keep talking about rebalancing. Doing it is hard. and doing it is hard, and also it's a difficult decision on many occasions, because that is when the market is going up. That is where it automatically happens. If you have chosen a vehicle, aggressive hybrid fund, which is 75% equity, 25% debt, it will keep it going, and there'll be absolutely no tax incidence. Not only that, given the tax regime that we have for the debt mutual fund, it has become so tax efficient, you don't have to bother about it. You will be liable for any tax or anything only when you realize your investments. And then doing a SWP as and when if you can actually hold a mutual fund of that kind for 20 years, I really wonder that the whole journey could be a tax-free journey for you if you go with a 4%, 5%, 6% withdrawal after you retire.
Housing, gold, silver, under the mattress, keep it in cash. That's been what Indians have traditionally, done. There seems to be a movement to saying, okay, now let's put that money into financial assets, let's put that money into FDs, into banks, and increasingly into the equity markets. That's a good trend, right? And it's something that will eventually stand India in good stead and stand investors in good stead. So long as they're not taking wild, risky things, I don't know, buying crypto and stuff like that.
Yes, you're absolutely right, Vikram. If you look at the Indian households, they have been great savers. If you look at FY22, 46-47 lakh crores of savings in one specific year, it is not a small amount. And secondly, we are great savers but very bad investors because we have been the largest importer of gold for many decades. And if gold was in rupee terms, it has given you the return. If you look at the data in terms of 1 year rolling, 2 year rolling, 3 year rolling, 5 year rolling, it underperformed equity significantly, and in several pockets underperformed debt as well. In Indian rupee terms, of course, it makes a beautiful jacket, which is the rupee depreciation, gives it 3-4-5% fillip. Otherwise, gold as an asset class, if it was a great global asset class, we would have been the richest country in the world by now. That's not the case because gold in dollar terms have stagnated for decades, if not. So from 1979, 1980, when I was born, till 2003, it gave a negative return. So it's only the only asset class I know which can give a negative return in dollar terms for 23, 24 years.
Okay.
So point is, if we look at data, I think physical assets will have lesser merit in one's portfolio. And I think we all should look at data for prudent decision making.
All right, Radhika, before you leave us, any specific advice you'd give? Look, people are concerned right now, right? There's war happening in Israel, there's a war happening in Ukraine, there's a possibility of what's going to happen to oil. Will there be political instability here or not? Yes, the Indian economy is in good shape, but who knows? And people are wondering whether small caps in particular have become too expensive and whether they should be moving into large caps. So any specific advice you'd give us on stocks or sectors before you leave?
So I think on market caps, I think there's a lot of noise on small cap, mid cap. I don't buy that narrative. I think a lot of the noise is because a couple of fund houses have decided to close down schemes. I think small caps are at the mid, and we run large, mid and small cap funds, are at the midpoint of the valuation cycle and at the early point of the earnings cycle. And I don't think the solution is to just run away from mid and small caps, or to move, hook, line and sinker to large caps. The solution is to take the middle path, which is probably multi-cap. The other specific advice I would give around Diwali, Vikram, I was in Delhi 2 years ago when everyone was rushing to buy crypto asset and every uncle at the Diwali party was asking me this. I would say in this bull market, keep a sane head on your shoulder. Don't fall for the frenzy. Really take the middle path. And with all the global volatility, realize that it is going to be there, but have the ability to zoom out.
All right, Radhika, thank you so much for joining us. Feroz, let me throw that same question to you. What would you be, and specific things that investors should not be doing?